Welcome to Real Estate Live, where your questions get answered. We get to the point of the hot topics everyone is talking about twice a week. We go live at 9 a.m. Pacific time on Monday and Friday on YouTube and Facebook. Today's hot topic is about, is it possible to get a home loan while unemployed? This is a question coming up a lot in real estate practice, and a lot of the questions that Bill Merren is getting asked on a daily basis. The questions normally sound something like, I have some money saved in the bank, so shouldn't I be able to qualify for a home loan? The second question sounds like, my credit score is a 750 plus. Isn't that enough? And the third question that's coming up a lot, especially more recently in the last couple of weeks, is, hey, Andrew, I just received my stimulus check and I'm getting unemployment. Can't I use that to get approved? So let's talk this through together and get the facts directly from the source with Bill Merren at New American Funding. I'm your host, Andrew Finney with King Realty Group in beautiful Las Vegas, Nevada. You'll want to stay tuned. We do have a special guest coming up later today when we get ready to go into the viewer Q&A, and he's waiting in the backside of the studio. So for now, let's get Bill Merren up so we can go ahead and get into today's hot topic. Good morning, Bill.
Good morning, Mr. Finney. What's going on, buddy?
Hey, another day, another live stream, and a lot of fun, and looking forward to a great time with everybody today. So my friend, I know that you said, hey, you want to jump right up into this topic because this is something coming up a lot. But before we do, would you give us some mortgage rate updates, please?
Yeah. So again, Andrew, like we've been talking about this last few months, is rates are still historically low, but there are things that do affect the interest rates. There's things that come out that might seem positive that all of a sudden the rates are taking a negative turn. So that being said, this morning we're getting kind of a recommendation to carefully float our interest rates, meaning, hey, if you're not closing within 30 days, or maybe you got like a week or so before you need to lock your loan, go ahead and float that loan and see kind of what's going on in the coming couple of days. The reason is because there was some news that came out, which is positive, which is really just awesome to see the positive stuff start coming out. Mm-hmm. There's a company by the name of Moderna that came out and reported that they got some good results from some testing that they did for one of a possible vaccine. There is some positive results that did get announced from that. It's not a cure. It's not a vaccine that's officially approved yet, but there was positive results. And when that happened, the stock market, responded very positively. The stock market, everything was sharply higher this morning. So mortgage bonds, of course, went down a little bit, which is bad for interest rates a little bit. I haven't seen it in my rate sheet yet, but we will potentially start to see that as the day and the week progresses. So again, nothing kind of urgent going on, but I would recommend carefully floating your rate if that makes sense to you. But again, if you are comfortable with your interest rate where you're at right now, and it makes sense, it's always a good idea to lock, because there could be something that happens to where the rates change literally within minutes. It does happen, but there is a lot of positive stuff going on right now, which is cool to see.
That is awesome, and thank you for that. And just out of curiosity, do you have any mortgage market updates for us before we jump into the hot topic?
Yeah, man, and this actually should have been a hot topic, which I'm sure we'll talk about more.
Okay.
We, as things begin to progress, lenders took a stance kind of in the beginning and did things the way to protect not only the company, but our consumers. Is we actually are coming back to some guidelines that we were at before. So we're going back down to a 580 credit score for VA and FHA. The guidelines have loosened up a bit. However, it's not exactly what it was before. There's still a little bit of, when you go below a 600, there's some reserves and things that are required and different stuff, but the guidelines are loosening up a bit. Mm-hmm. There is still a shortage in the jumbo world and HELOCs and stuff that we talked about last week. But yeah, looks like we're starting to take a turn towards a positive, at least at New American Funding.
Okay, so that's awesome, and thank you for that. So now, Mr. Bill, here comes the big thing. Home loans for the unemployed. How does that work, my friend? Especially considering those three questions I led in with that we're getting quite a bit. And take it away.
So great question, because we're getting it asked a lot, and it's, man, people's hearts are in the right spot. Hey, man, I'm still good. My credit score is still great. I got income coming in. And some people, it's even more than they were making before because of the extra from unemployment, the extra boost that you're getting. So there's a lot of positive stuff going on. People have, listened to what other professionals have recommended. We recommended keep making your mortgage payments, keep making these payments. But if you're currently furloughed and you are not receiving income from your job. You're not back at work yet, but you're still getting paid, and you need that income to qualify for the loan. It's just not going to happen. We can't approve you for a loan based on a job that you're not currently working at, even though you're getting income, even though you're getting, even though you're getting paid from the unemployment, even though you're getting paid from that, and you have money in the bank and your credit is great. We have to wait until you go back to work, because we don't know the probability of continuing employment at your job, and people have to go back. It's just super important. People need to understand to continue doing what they've been doing, with making the payments on time, making your credit payments when you need to, making your car payments, making your credit cards, your house, all of that. Because when everything does come back and, you do go back to work, you're going to be in a good position, because there's going to be a lot of people who didn't listen to that recommendation. Maybe they couldn't make the payment. Maybe they got behind on different things and there was no choice. But if people are in that spot and they continue to follow through on doing that, when this whole thing opens back up and the economy, what I believe personally is going to take off like a rocket ship, when that does, you're going to be sitting in a good spot. But you need to wait until you go back to work if you need the income to qualify.
Okay. So that's an interesting point, but that does bring up some other questions, Bill, that come up in my mind's eye, and about, can I get a home loan while I'm unemployed or furloughed? Let's say somebody is a joint applicant. And for everyone watching, if you're unfamiliar with what a joint applicant is in a mortgage, let's say that you're married, or you have a significant other, that you're getting married, or you just have that relationship that you're comfortable with applying with somebody together for the mortgage. So that's one angle. And then the second angle is, how does this option of co-signing fit into this equation, if at all? So there's two different questions right there I'd like to air out with you, Bill. So could we lead in with the first one with joint applicants, please?
Absolutely. So joint applicants is, and there's another individual that you're buying a home with. Could be a spouse, could be a boyfriend, girlfriend, could be, a family, whatever that situation is. If you guys are buying a home together, and the individual's income that is on furlough or not currently working, if that's not needed, then you can qualify solely with the other individual's income alone, then yes, you could potentially qualify at that time to do that. And that's important, because a lot of people, might have heard that, that you can't do that anymore, that guidelines are too tight, you can't have co-signers. Not the case at all. You absolutely can, but you have to qualify with both people's debt, right? Mm-hmm. If the individual who's furloughed, not currently having income, but their credit is great. So say like a husband and wife situation. Husband might be furloughed, wife has a job, she's still making great income, they both have great credit. The husband should not be on the loan, still go on the loan if you qualify with the wife's income. So that way, when everything's said and done, you're still on the mortgage, you're still entitled together, and you're still good to go. So definitely, co-signing is definitely a great option.
So what would happen in such a case? Because, I love putting you on the spot, especially on live streams, Bill. That's just how we roll, right? But you're good for it, right? Good. So when you're talking about joint applicants and married couples in specific, you're saying go ahead and go on there, because everybody's debt, the income ratios essentially have to be balanced out. But let's say that if you did have that situation and a husband and wife could qualify for, let's say, a $500,000 home together. Yeah. You lose one income from the sounds of what you shared with us a moment ago. How much could they qualify for then? Would they still be able to get a $500,000 home if they wanted, or would they have to tailor back to the active income side of the spouse?
You can only use the active income.
Okay.
Without a doubt. So great point, Andrew. And if I totally get it. If you qualified for a $500,000 home, and then maybe with the other person's income alone, because of both debts and because of both situations, hey, maybe now you only qualify for 300. That's a totally different neighborhood. And if you're not comfortable buying something that you don't really truly want, and your spouse is going back to work, what I recommend, and Andrew, I know you and I have talked about this quite a bit, is get the application done, spouses together. Even if you're furloughed, get the application done now. Let's get you in, let's get you underwritten, approved. Let's gather all your documentation together. So that way we're ready. So that way, when everything opens back up, when you go back to work, you get that first pay stub or whatever that situation is, they're not behind the 8 ball and trying to compete with everybody else who now is coming out of the woodwork. So important to understand, and we're doing that a lot right now. We're just kind of stacking them up. So that way, literally all we have to do is, just verify a couple things and then lock, dock, and fund it. I mean, it'll be much simpler of a process if they do it now.
Good stuff. So I appreciate you letting us know. So do you have any thoughts about the cosigner option? Let's say that somebody is currently unemployed or furloughed, but has a family member that could cosign for them or a friend that could cosign for them that has stable income. How would that work in the case of the primary borrower being unemployed or furloughed and the cosigner being actively working? Is that an option?
Yes and no. So if the primary borrower is not employed, it's not their spouse, it's like mom that's wanting to help out.
Right.
If the primary borrower has no income whatsoever to qualify, that essentially becomes like a non-occupying cosigner situation, turns it into an investment property, in that situation, which changes the dynamic of everything for the loan. I would recommend not, potentially doing that unless you need to, because you're looking maybe 60, 90 days out before you potentially are going back to work, maybe less, hopefully, hope to God, less. But that is an option to do the non-occupying cosigner. But if the primary borrower does not have any income at all, I don't believe, and I could be wrong, haven't had this come up yet, but I don't believe that would still be able to be a primary home, because that primary homeowner has no income on the actual application.
So then it turns into the investment property. In the case of the cosigner, it's a second home. And at a second home, then you have to meet those guidelines, which normally going to have a bigger down payment. Not always such a favorable interest rate compared to the primary home, correct?
Yep, so, exactly.
So there's different options. So in short, if you're looking at can you get a home or a home loan rather, whenever you're unemployed or furloughed, the answer really is yes, no, and maybe so. It depends on the situation. And we hate to say that, but in the reality of real estate and mortgage, it really is that situation. And the reason being is everybody has a different economic position. Everyone has a different personal dynamic. If you're married and you guys are comfortable with the amount you can qualify for in the homes that are available at that time, then sure. I mean, make a well-informed decision that's right for you. If you're not comfortable with that because you want to qualify for more home, then hold back, as Bill was saying, until you return to work and just go ahead and apply, get your application and all your ducks in a row and ready to go, so that when you do go back to work, you can go out there and buy it. And be aware of the trade-offs of the cosigner option specifically, and I'm glad that you mentioned it, a non-occupying borrower, and how that translates into a second home option, even if they're really realistically applying with somebody that intends to be a primary home. So Bill, those are all extremely good points. And I think that should answer a lot of questions of anyone that's out there. And if it hasn't, hey, we're live right now. Go ahead and use the chat box to hit us up live right now. With any questions you have, post your question in the comments below. If you miss us or if we miss your question, please, our goal here is to make sure that you guys are comfortable and confident, that you know what's happening in the market and making things happen. Now, as promised, we do have a special guest here with us today, and I'm super excited to bring him up here in a moment. And here's the thing. This gentleman actually does have a YouTube channel, I just found out this morning, and you may recognize his name for everyone that's actively in the streams like every time or watching it after the fact. His name is Drew's Enthused, and he has a channel called Drew's Enthused. And I was checking it out, and it's pretty cool stuff. And his passion is to talk about mountain biking, and he has some positive things that he wants to share with you today. He was actually waiting in the stream studio before I even arrived. So let's bring him up because he's got a lot of wonderful things to share with us. Hi, Drews. How are you, sir?
Hey, how's it going, everyone?
Good, good.
Come on, buddy.
So, Drews, where are you coming from today?
I'm in Phoenix, Arizona. There's enjoying one of our last beautiful mornings we're going to have.
Last beautiful mornings. Oh, my God. Is apocalypse coming? I mean, tell me what's going on that I don't know.
Summer's coming.
Summer's
coming. 120 degrees by 8 a.m. It's rough.
It's a good point. We feel you. We're your sister city over here in Las Vegas, so we get the same thing. So, Drews, you were telling me a lot of really fun stuff this morning before we went live, and you had a recent major life milestone that you just achieved. What was that?
I bought a house with my fiance. And,
congratulations.
Thank you. Thank you. It's been quite the journey. It's all been amazing, and we couldn't be happier. I mean, we could probably be happy.
And how was your experience buying your house?
It went really smoothly. I actually got my realtor from a mountain bike buddy of mine.
Nice.
And the lender that his group works with was fantastic, and yeah, it all went really smoothly.
Well, that was great to hear. And you shared that you wanted to bring some positivity to the live stream. And I really do appreciate all the comments that you leave on the channel and the fact that you're trying to always catch the live stream and you catch it after the fact, if not. But what are some of those thoughts that you wanted to share with everyone in the United States right now?
Did we talk about this one?
Yes.
I mean, I was praising you in the information that you've been providing everyone, but I'm not too sure what you're referencing.
That's fair enough. So the positive mojo gojo is something that we always want to do because we're stronger and better together. And if we move #beyond fear, that false evidence appearing real, we can make well-informed decisions that are right for us. One of the things that you had shared with me was that you had appreciated the way of just being clear and being balanced with the approach and how to help people move forward with a well-informed decision by thinking it through and calming down to make those thoughts. And I believe the fact that you just recently purchased your home in the COVID-19 market is a very positive experience. And you shared with us that you got a killer rate. And now you're sharing with us that you have a fiance that you bought this home with. So hopefully that means there might be wedding bells in the future for you, and maybe some little pitter patter of some feet maybe in time.
We were planning on October or late September, but we've put it all on hold right now. We don't want to like burden people with getting here. We'll wait for everything to, go back to whatever the next normal is, and then go from there.
Cool stuff. Well, Drews, I just wanted to give you my heartfelt thanks and appreciation and give you the praise, my friend, for having the courage to come on the live stream with us today. And it really means a lot to me. Thank you. And I love engaging with our community. It's our tribe. And, my friend Sean Cano likes to say, your vibe attracts your tribe. And it's so nice to actually see a member of our tribe with us. And it's a good vibe. So I love it, Drews. So I'm going to wish you a fantastic day, my friend. And I'm going to let Bill and I jump into the viewer Q&A at this point. And I just wanted to say again, thank you. Congratulations on closing on your new home. Please say hello to your lovely fiance. And if there's ever anything we can do to help out, feel free to give us a jingle or hit us up.
Thanks for all your help, guys.
Fantastic.
Hey, great meeting you, buddy.
Have a good one.
You too.
Okay, Bill. So I see that we have some questions coming in and some positive mojo. I love the positive mojo. And Drews, for everyone just joining in after we're streaming live, or if you're just catching us now, is one of our members of our tribe, and your vibe does attract your tribe. And to me, it's so amazingly powerful whenever members of our community want to come on during the live stream. To me, the best part of the live stream is about having a true and genuine connection with you. And that's the depth that's from my heart. It's why I started creating these videos 4 years ago and trying to help people, was wanting to have that connection with you and to help you make sense of what's happening. And when you want to step up and go on stream, if you're comfortable with it, of course, then it's something that I think our live streams can become so much more powerful with. So I'd ask anyone that is in the stream or watching now, why not come up, introduce yourself, even if you just want to say hi, feel free.
Yeah.
You saw Drews do it, and I applaud his courage in doing so. And if you're catching us after the fact, then hey, if you happen to catch us during the live, just use the link in the show more description. I always have it on Facebook and YouTube where you can just hit that link and you'll be able to come up. Anyways, let's go ahead and jump into some of these questions. So we have Nicoletta. Nicoletta, thank you so much for being here, my friend. I hope everything is going well for you. It's always great to see you. Carmina says, good morning, Andrew, Bill, and Nicoletta. Good morning, Carmina. Thank you for being here, my friend. Jamal Bates says, hey, Jamal, what's up? Hey, thanks for being here, my friend. It's good to see you. April. Love you long time, April. Thank you for joining in. Love your positive mojo and your energy and the comments that we had going back and forth the other day on the Hernandez family's episode 5. So really, really appreciate that. Jamal says, does Bill lend in Arkansas? Bill, do you lend in Arkansas, my friend?
So we have a team that handles the United States pretty much across the country. So if anybody watching this needs help with either buying or refinancing, definitely reach out to me. give me a call. We can talk about your situation, see if it makes sense to have you do an application. If you want, you can also apply online at my website, do the application there, and then I can get you connected with a local loan officer in your area where you're actually living. If you prefer to meet with someone in person, we can maybe potentially do that as well. But again, if you are in, Arkansas, if you're in Phoenix, if you're in Michigan, if you're in Florida, we can definitely help. So we'd love to work with you. We'd love the opportunity to be able to help you out in your home buying process. So yes, if you do need help, please reach out and we can see what we can do.
So Jamal, just to give you a heads up, the screen that you see on right now is Bill Merren's application page. And the reason I like to pop this up, it's just a cool page. Number one, it just is a pretty landing page, but it has all of his contact information. And just for reference, Jamal, I do have all of Bill's direct contact information in the description on both YouTube and Facebook. And I see that you're joining us on YouTube, so that's fantastic. Thank you for that. And what you could do is you can reach out to Bill directly if you wanted to complete an online loan application, and then he can process it through to his teammates over in Arkansas to better help you. Whatever we can do, I just want to let you know that this is how you can get in touch with him, and his website URL is billmerrenloans.com. So Jamal, thank you for joining us, my friend. Greatly appreciated. So Bill, let's see what else. Ben. Oh my God, Ben, thank you, my friend. That is some tremendously wonderful news, just like Drew's enthused. I don't know who's more enthused right now. I'm super enthused. So Ben says, good morning, guys. Just want to let you know I locked in at a 3.25% 30-year fixed rate mortgage. Super excited. And I closed June 2nd. Ben, that is tremendously wonderful news. Congratulations, my friend. Let us know when you get the keys to your new home. And for reference, Ben, I do have an entire playlist dedicated to just home ownership that you might want to check out next. Alicia, good morning, Alicia. Thank you for being here. Alicia says, good morning. What lenders do you guys recommend to check out in Phoenix, Arizona? Thank you for joining us from Phoenix. I know that we have some other, obviously Drew's is in Phoenix today and he was live with us. And I know there's some other viewers and part of our tribes that like to join us from Phoenix as well. So great question, Alicia. Bill, why don't you go ahead and take that one, my friend?
Yeah, and I will kind of piggyback on what we said before. Again, Alicia, if you're in Phoenix, you guys are right down the road from us, essentially. I mean, we definitely can help out. If you go online, do the application, we can get everything going, get you referred out to either someone out there in your area where you can see somebody live, or we can just handle it all for you over the phone with my team that handles all the different states across the entire country. So I know there is other lenders out there. There is other local lenders and other things. I think Drew's enthused, man, awesome. You had a great experience with that lender. All lenders, guys, are not created equal. There is a lot of things when it comes to the mortgage world of different companies. Even though the guys might be great, they might do a fantastic job in certain situations. But with New American Funding and what we do, it's a little bit different, very different than a lot of companies out there. We actually service our loans. So we service 90% of our own loans, our FHA, conventional, VA. We service them, meaning when we close on the loan, you're going to continue to make your mortgage payments to our company, not going to get sold off to different people. And there's different guidelines, different things that we can do because that loan is actually staying in-house, while other lenders might tighten up guidelines and not even allow certain things. And unfortunately, I have heard other lenders saying that certain programs are gone, nobody else can do them, but I'm doing a lot of them. So again, check out your different options, but we can definitely help you, Alicia, if you're there in Phoenix looking for somebody to help get you pre-approved.
Good stuff, Bill. So did you like that flash in, and make you full screen? Yeah. So I was doing a really awesome live stream interview the other day. I was super honored and blessed to be part of it with Sean Canal's team over at Think Media. And I was watching the way they were doing the stream, and I was like, oh my God, I'm trying to stream live. There's thousands of people live at the same time. And the chat box was like, I don't know. That is so amazing. It's like every 2 seconds, there was 120 new comments. I was like, oh my God. And then they asked me this question, and then they flashed me up on the screen the whole time. And I was like, okay, you know how to make videos. Hashtag JTAB, just take a breath, reassess, stay calm, don't lose your mind, and focus on being present in the moment. And it was a fantastic time. But that said, I'm learning new things and how to make the streams better. And I thought I would try it out. So I'm glad it worked instead of me booting myself off the stream. So you take a go at it. So it's always fun. So we're having a good time here this morning. Yeah, Drew's wanted to let him know that Fairway was who he used. It was a good experience. Bill gave us some information about vetting out your loan officer, so that's great. Claudia, thank you so much for joining us this morning, my friend. It is great to see you again. Sevia, thank you for joining us, my friend. It is great to see you too. And that is actually really good news, Sevia. So Sevia says, good morning, Andrew and team. I'm back to work now. So I've been missing these, but I'm listening to you on my commute. That's actually good news. And since it is a live stream, if you're able to catch us, Sevia, much appreciated, whether it's on your commute and you're listening more or less like a podcast format. That's terrific. But the best news of all, other than you being here, of course, is that you're back to work. And I wanted to say thank you because I think that's a positive mojo gojo for everybody watching right now that may not yet have returned to work, knowing that people are starting to go back to work. So Sevia, we wish you a beautiful day, an amazing work day, and may it be productive and prosperous for you, my friend. HH says, with all going on, will the same rules apply for having job length within the same field as far as just staying at a new job elsewhere? Okay, so that's actually a really good question. And I believe the correct paraphrase, if I may, HH, would sound something like, hey, if I've been unemployed or furloughed for the last 3 to 6 months, right? Can I still get a home loan, or is it going to count against me when I go to do my application? Or what happens if I begin new employment?
Yeah, so great question. There's a common misconception for a lot of people that think that you have to have been at the same job or in the same field for at least 2 years to qualify for a loan. That's not true. That's not the case. Back in the day, maybe before, I've been doing this for almost 15 years now, maybe before that you did, but you don't have to. So the thing that you want to look at, though, the thing that does kind of affect things and can cause you to not be able to get pre-approved or close on a home for quite a while is if you totally change the way that you're getting paid. So if you go from being an hourly employee to all of a sudden you go and say, hey, these videos are great. I think I'm going to go become a realtor and do what Andrew's doing. Hey, you might do great. You might be making some decent income. But if you go from being an employee on like an hourly or salary type situation to where you go to being a commissioned person, you're going to have to wait to qualify for a home loan. So if that does happen to you, then that will affect the pre-approval. But if you simply change from, say, hey, maybe you were working in payroll at, Las Vegas, just using us for example, you were working at payroll at MGM, MGM might not be getting hired, might be doing layoffs and that kind of stuff. And you get a job working at, say, Caesar's Palace, and you're changing jobs, but you're in the same type of, you're getting the same type of pay, whether you're out, you're going from hourly to hourly or from hourly to salary, you can still qualify potentially to buy a home. So nothing's really changed with that. The big thing to do is, that I think is going to have a huge effect on a lot of people being able to buy right now is the gap of employment. You have to look at how long that gap of employment was to where you were furloughed, meaning you weren't working. You might have been getting unemployment. You might have been in a situation to where, hey, you were okay, but your bills were getting paid, but you were currently unemployed. And we cannot use that unemployment income to help you qualify for a home. Now, different lenders are going to look at this differently. We have not gotten a 100% clarification and official word on how we're going to do that. But what I did hear is that we are more than likely not going to hit homeowners or people wanting to buy or refinance with that gap of employment. Meaning, if you were not employed for 3 months, typically if you're in an hourly type situation, that 3-month gap of no income is going to crush your year-to-date average, and you're not going to be able to, in most cases, get approved. Well, from what we're hearing, again, not officially announced yet, but from what we are hearing, is more than likely we at New American Funding are not going to hit you with that gap, meaning we're going to basically just kind of treat it like it was never there. So that's great news. And that's for not every loan, but that's for most of the loan programs that we're going to be doing. So if you are in that situation, if you do want to have like an in-depth review of your qualifications when it comes to that, please reach out to me. I'd love to talk to you about it and see what we can do.
Good stuff. And once again, if you want to reach out to Bill directly, his contact information is billmerrenloans.com. And that's what the page looks like. If you land on that page and you see his smiling mug right there, you found the right guy. So good stuff. Appreciate you, Bill. So let's jump over to Kyle. Kyle, thank you so much. This is some really good news too. And it looks like you do have an interesting question here as well. So let's get to it, Kyle. Kyle says, hi guys, thanks for the advice last week. We still haven't closed yet, now hopefully May 27th, but got locked in at 3.125%. That's a smoking rate. Sellers took forever to sign extension, so it's delayed. So Kyle was due to close, if you recall, from last Monday's stream. He was due to close last Friday. So Kyle, thank you for letting us know what happened there. So now let's go to the interesting question. Interesting question from Kyle is, what is the longest escrow period you've experienced? We've been waiting since our offer on March 11th. This is absolutely an insane process. Bill?
So it is an insane process, but we're also in insane times right now. So the fact of the matter is you got a rate locked at 3.125. You're going to, that rate, depending on how long the lender locked the rate, whether it was 30 days, 45 days, 60 days, hope to God, not a 15-day. But depending on how long they lock that for, if the escrow goes past that, you want to be in tight communication with them, find out when that lock expires, because if that lock needs to be extended, if it was at the fault of the seller, if the seller is the reason that this has been delayed, which, hey, it might have been, it might have been their fault because maybe they couldn't move. Maybe they're in a process of maybe wanting to buy a home as well, but maybe they're furloughed, maybe they're going back to work. So you want to be in communication with all parties on this, as far as with your agent, to communicate and see what's going on. You want to make sure that lock does get extended. I have had normal escrows, resale, not new construction. New construction can take, 6 months, a year in some cases. But in this, I have had normal escrows take 60 to 90 days. Me personally, I bought a home last year, and Andrew, this is 2 months, mine was a 60-day escrow, I believe. So every situation is different. So you want to really, truly just make sure that rate is protected, because if you go to try to lock that rate again, I don't know that's going to be there.
Yeah, and I guess it was kind of interesting, given our experience and the amount of times that we've helped so many families together. Working with you personally, by your personal residence was fun. It really was, because I love and adore your family. But yeah, so it's important to take context of why you see different lengths of escrows, because Bill was a longer escrow last year for him and his family, given unique set of circumstances for his family. I actually worked with another family that was even more of a unique situation, with a more similar situation to what you're experiencing, Kyle, in some ways. And that family, here was the deal. The person's house that they were buying was in contract on a new construction property, and it wasn't going to close for like 4 months. The buyers needed to get some more reserves saved up so they could qualify for a very specific loan. And they knew, and they were on an annual salary, so they knew exactly how much they were going to have. The lender said, yes. Bill said, yes, we can do this. So we put together essentially this 4.5 month long escrow, where we wouldn't close on the home until 30 days before the seller needed to be moved out. But we went through the entire closing process cycle, from the home inspections to the appraisal to getting everything done and taken care of, right? But this was an agreement done up front. The thing that's why I said it's similar. Now, what's dissimilar is that last statement, where I said this was an agreement where all parties knew what was happening up front, which is always the best practice, frankly. So you're saying that you've been waiting since you made the offer on March 11th, and it's been kicked back a little bit. So what comes to my mind is there a seller leaseback in place? Because if the seller needs more time, why don't you have a seller leaseback? That's just a very specific document that we as real estate agents have. And it's not, even if their MLS board doesn't have that document, it's not too hard to put together, because I've made videos about it, teaching consumers, and matter of fact, I guess if an agent watches it, teach them how to do it too. But it's a seller leaseback arrangement, which means that you would close on the house. The seller has essentially become a tenant of the property. They have to have their own renter's insurance. They have to be out by a specified time period, and they're paying you a per diem rate, which means that they're paying you every single day a certain amount of money agreed upon for the use of those premises until you can move in. Normally, the way that you orchestrate that, Kyle, is by saying, hey, how much is your monthly mortgage? Divide it by 30. That's the prorated amount that you're due. And the way that I like to structure this, and escrow companies probably love me for this, but this is the way I try to keep everybody above board, is I'll write into the terms of the seller leaseback that the funds are to be taken from the seller's net proceeds, left in the escrow account so I can make sure they don't spend that money, right? And then paid to the buyer in arrears, which means that once they moved out, you get paid, right? because what happens if they move out much sooner? Now it's a prorated basis. And that there would also be the need of a second final walkthrough upon buyer satisfaction, right? And also they would need to be making a deposit should damage occur to the property. So these are all the things that go through my mind. So when you ask a question about like, hey, or you mentioned that, that's what goes in my mind immediately is, hey, how can I protect my client? How can I protect Kyle here in this situation? And as a real estate advisor, boom, my brain starts kicking in the high gear. I start slamming back and say, hey, look, the seller needs more time. How much time they need? Because either they need to get out of Dodge because the buyer needs to get in there because that's their new Dodge City called their house, right? Or we need to orchestrate a seller leaseback arrangement so everybody is meeting halfway and everybody's made whole. So these are thoughts that come through my mind, Kyle. These are questions that I would suggest that you get with your real estate agent that you're working with to have that conversation with them and find out exactly what the heck is going on there so that we can get you the keys to your new home so you can move in, my friend. So please keep us posted, Kyle, on how that works out. Drew's enthused. Hey, Drew's. He thought of a question. He got another question. Drew's, I love you, my friend. So he says, Andrew and Bill, what's the oldest house you've owned? Bill, what's the oldest house you've owned?
2004.
Oh my goodness. Are you kidding me right now?
Yeah.
2004. Yeah. Okay. So the first house that I purchased, Drew's, was a 1984. So that's the oldest house that I bought was a 1984. But again, put it in context. Vegas doesn't have a whole lot of properties, even though I was watching a really interesting docuseries the other day about 1920s era Las Vegas. I learned all kinds of interesting things, Bill, from the 1920s and Las Vegas history. But that said, we don't have 1920 era homes available. It's just not a thing. A lot of the strip and a lot of the fanfare of Las Vegas is tear down the old and build the new. And that's kind of what you've seen. Now, 100 years from now, my guess is that you'd probably have homes that are today's era, because I don't think those homes are going to go anywhere unless something happened to them. But, our age and as a city and our age as the way the city has evolved isn't old enough to have like East Coast type properties where you can actually buy a home from the 1800s, so 1700s in some cases. We don't have that kind of history here. But that's a really interesting question. But oldest that I owned was 1984. I was very specific to that because I didn't want to be dealing with asbestos and I didn't want to be dealing with the potential of having lead-based paint. So I was very specific in making sure that I wanted a house not any older than me, preferably. And in 1984, dating myself a bit, is still quite a bit younger than me. But that said, let's move on. So 2004 for Bill, 1984 for me. Fun that we both ended with the 4, 20 years apart. Almost like a reality. So, Monkey, thank you for being here, Monkey. Monkey says, how low can the mortgage rates go? Or how low has the mortgage rate gone in times past? Makes me think of that limbo game, right? The Hawaiian game where you're like, how low can you?
But this ain't a game, Andrew. This is crazy. So, guys, the one of the biggest things that affects mortgage rates is, unfortunately, it's bad stuff going on in the world, bad stuff going on in bad news and that kind of stuff that affects rates. So, please, if you are thinking that you're going to hold off until the economy completely tanks and the rates just drop to 0%, please, please, please reconsider. If that's the only thing that's keeping you from being able to buy or wanting to buy or whatever, I would reconsider, because guys, we just had just an unprecedented thing that's still going on that I believe that we're on the tail end of with the whole COVID-19 situation, where rates are historically low right now. They do go up and down a little bit here and there every day with what we're seeing, but I believe that we've kind of seen the worst of that, and I believe that we've seen potentially, my opinion, a lot of the guys that I follow, the guys that make a living off of, looking at mortgage rates and why they do what they do, I believe that we're about there. I believe that, that the rates right now, I don't see them going much lower. I don't see them going to 0% is not going to happen. So please, if you are considering just holding out to seeing if rates drop lower, I would recommend reconsidering and give me a call. Give me a call. Talk to me about it. Let me kind of hear your opinion on it and what you got going on. But rates right now are historically low. So just my opinion, I recommend not holding out and thinking rates are going to get much lower than they currently are, because they are so stinking. But rates, in some cases below 3%, a lot of cases 3.25%, 3.5% around there. phenomenal rates.
Good stuff. So thank you for sharing those insights. And Monkey, for reference,
Yeah.
you know, I tend to nerd out on this thing called real estate and mortgages. I need Bill because, you know, he's like the licensed loan officer, I'm just a real estate agent. And Bill tells me sometimes, Andrew, you got to let people know, you know, I know you don't like talking about you, but you got to let people know you're an active real estate agent in Las Vegas. So if you're watching me and all of my videos over 600 and you haven't, you know, for some reason made the connection, I am a full-time real estate practitioner here in Las Vegas, Nevada. I call myself a trusted real estate advisor because I don't sell you. I prepare you with well-informed, I answer questions, and I make sure you're a well-informed home buyer or home seller. And that's why I don't use the word sales agent. That's why I use the word advisor, because I prefer to advise and help you with the biggest purchase or sale of your life. But that said, going back to that nerdy comment, here's the deal. I believe it was in my 2019 predictions video, right, that I did this. I actually went back on historic averages on the 100-year historic average for real estate appreciation, calculated it. Also making note of all the different depressions and economic downturns in that time period. I also did the same thing for the information I could collect on mortgages. And the data on mortgages I was able to collect went back 50 years. I averaged all those out up to the present in 2019 and found that the average historic interest rate for a home loan was approximately about 8.7, 8.8%. That's normal. The highest that it ever was in the early 1980s, and it was just under 20% for a home loan.
Yeah.
So when people think with a frame of reference, it's important to put historical context in the situation, because when you think of the rates under 5%, 6%, I mean, even going back into like the 2008 period, when you want to like, hey, what were the rates back then? Well, if you could get a 6% rate back then, you were smoking, that was a smoking low rate back then, because a lot of people were getting 7s and 8s. So the reality is when we see these rates sub 5% or sub 4, this is a really good time. And it's important to take stock of the situation, opportunities that are available to you, because the most important thing is to understand what's called like a time value money and opportunity cost of time principle when you get ready to buy a home. If the situation makes sense, you can get the best of the rates according to your income, your credit score, and your situation, and the time is a good time in your life to make a purchase, do so. Because if you own that property, then what can you do later? If you see a lower rate, you could refinance the property. Will it cost you some money to do a refinance? Of course it will, because you're doing a new loan of sorts. But if the rate is that important to you, understand the trade-off of what you're looking for. Because if you try to time the market to the lowest possible rate, look, the real estate appreciation rate probably will be 0, maybe a little bit negative this year at the end of the day. But here's the deal. Those prices are very, very stable, and market real estate pricing is not going to be dramatically impacted by COVID-19 or what's going on with the economy right now. It's just not going to happen. So with that said, it's important to take stock and get real with that, because if you have the opportunity to make a step forward in your life, do it if it makes sense to you for the reasons that are important to you. Just weigh everything out, write down the reasons why you want to buy a house, write down what's most important to you about buying a house, and gain clarity and insight into your decision-making process. Then pull the trigger or don't pull the trigger on your home purchase. Either way, choice is up to you. But if you look back, your future self looks back on you, Monkey, 12 months from now, 24 months from now, and you're still not owning a house and rates are 6%, what are they going to tell you now? Something to think about, something to consider. So let's move forward. HH gives us the thumbs up. So I think right there. There we go. There's a thumbs up. Thank you for that, HH. Okay, perfect. Thanks. Louisville Blues, thank you for joining us. Louisville Blues says, is there a way to request more loan for furniture and sprinklers, etc., apart from a home loan when applying for a mortgage? Great question, by the way.
So great question. So apart from a home loan, not sure if you mean like a separate mortgage or maybe like together. So there is something called a 203K loan for FHA loans, which is a phenomenal loan program. It's important to work with a lender who's experienced doing them and knows what they're doing, because the process really shouldn't be too scary if they know what's up. But it can be horrific if they don't know how to do them. So a 203K loan is a normal FHA purchase loan to where upgrades like appliances, countertops, cabinets, paint, floors, things like that can be financed into the loan. None of the work happens after during the mortgage process. It all happens after closing. But in regards to specifically furniture and sprinklers, I'm assuming that sprinklers outside, not in the house. No, you can't include furniture or sprinklers in a mortgage unless you already own the home and you're doing some type of cash out refinance to where, hey, you got $100,000 in equity in the home. You don't want to take it all out, but maybe you just need, 50 grand to maybe update your kitchen. You want to maybe put some things in your backyard, do some furniture and some sprinklers. Hey, totally fine. We're doing that a lot right now for people. So I hope that answers that question, Louisville Blues. And if you got any more questions, man, just definitely reach out and let me know. Shoot me a text, call, email, whatever you need to.
Great point. Great point. And Louisville Blues, that is a very good question. I do want you to know on the real estate side of this, the way that we would handle that in real estate practice, if you were purchasing a home and there was furniture that could be available for sale, it won't go onto the mortgage for all the reasons that Bill just shared with you. Yep. But there is something called a separate bill of sale, which is like a private bill of sale. And what we like to do as real estate practitioners, or at least this one does, is I like to write up an addendum to a purchase agreement specifying what the seller is selling, have pictures taken of everything, have it broken down by model number, depending on how expensive stuff gets. And that said, have it agreed upon in writing through escrow so that you have the protection of the closing process itself to ensure that everything transfers over to you. But part of that proxy is that you as a buyer would have to pony up the cash as part of your cash to close to satisfy that new addendum to the purchase agreement. So sometimes you see buyers and sellers try to do this offline. Sometimes that works. Sometimes it doesn't. You bring that to my attention, I want to try to protect you, give you your options, and then let you choose the one that's best for you. But it's a great question. Alicia says, Bill, from your experience, is there an amount you have to make a year to get qualified for a specific amount? For example, if you make like $60,000 a year, you might get approved for a $200,000 house. It's a really good question, Alicia.
It's a great question. It's kind of answering this question is kind of like a slippery slope to a lot of different things. Because if you make $60,000 a year, you're probably not going to be buying a $500,000 home, right? You might be doing just exactly what you're saying there, maybe 200, maybe 240, something like that. So there really is no way to exactly determine how you're going to be able to, hey, if I make 100 grand a year, can I buy $1 million home? Probably not. It's just using some common sense when it comes to that, because there's a lot of things that come into play. Because if you make $100,000 a year, but you have a spending problem and you have a lot of, you like nice things, and you might have $1,000 car payment, you might have a boat and jet skis, you might have a lot of toys. Well, all of a sudden that $100,000 a year income earner might have less purchasing power than that $60,000 a year earner who is more disciplined with their budget and their finances. So it's pretty difficult to say, hey, if you make X, you will qualify for X. I'd recommend completing an application, allowing me to look at your credit, see what's you really got going on, and then guide you down that path. But I think, Alicia, you're on the right track with that. $60,000 a year, times 4, you're looking about 240-ish. I mean, that's ish about what you're looking at. But it's pretty difficult to say for everybody across the board if you make X, you'll qualify for X. But great question though.
Yeah, I definitely love the question because it comes up a lot. That is one of those things that come up a lot too in real estate practice. Hey, Andrew, before I talk to a loan officer, this is always, we real estate agents get hit with everything. Yeah, Andrew, before I talk to a loan officer, about how much money would I need to qualify for this type of a home? And it's always coming back in my mind's eye, well, heck, you could technically earn $1 million a year, but if you have debt that exceeds, $50,000 a month on your, let's just use $1.2 million a year for a crazy example here. And you earn $1.2 million a year, $100,000 a month, and you pay out $50,000 a month in debt, and one of them is not a mortgage, you're at what's called a 50% debt to income ratio. So you can qualify for exactly probably nothing, despite such a high income, because there's these rules that get applied. So when Bill was sharing with us, it's a slippery slope. It really is. So even if you earn $60,000 a year, does that guarantee that you could buy up to potentially a $200,000, $240,000 house? It depends on your debt. So it really comes back to everything he shared with us about the debt to income ratios. Every person's situation is unique, and it's important to process an application with a loan officer. And if you're here in Vegas, process it with Bill, have a conversation. He'll guide you straight. So great question. Really appreciate it. HH says, love the series. Keep them coming. Most deaf. Louisville Blue says, is there a benefit to going with a lending company owned by a builder for a mortgage? In your experience, do more people opt to do that, or do they prefer outside parties?
Man, so Andrew, you and I have talked about this a lot. We've had this come up a bunch. So it depends on the builder. It depends on what they're actually offering by using their lender. Sometimes it might be $1,500. Sometimes it might be $2,500. Sometimes it might be a little bit of upgrades towards the house. Sometimes it might be $15,000 or $20,000 that they're going to give you by using their lender. Now, depending on your negotiation skills that your real estate agent does have, they might be able to still get that for you if you use your lender that you're already working with, as long as they have a good reputation and whatnot. But there is a lot that does happen with that, even though I work with a lot of home builders, I work with a lot of people buying brand new homes, but there is those cases that Andrew and I have had that do come up to where, hey, it just doesn't make sense. I can help people out with, giving them money towards closing costs. I can help them out with, helping out in those situations. But if it's somebody talking about $15,000 or $20,000 that they're going to give to the buyer towards upgrades or towards, closing costs, whatever that may be, I can't compete with that. I don't necessarily agree, and I might get some heat for saying this, but I don't necessarily agree with how they're able to get away with that. It's one of those things that's currently going on right now. I don't understand how they do, because, Andrew and I can't do that. He can't say, hey, I'm going to give you X if you use Bill. It's just not something we're allowed to do, because for Andrew and I to do it is actually frowned upon pretty heavily. So if you do have a new construction home in mind with a home builder you're wanting to work with, make sure, please make sure that you're using a real estate professional to represent you. Because even though I have a lot of great builders and things that I work with, and they do a phenomenal job, they also represent the builder. You need to have someone representing you as a real estate professional. And like Andrew talked about earlier, on the fact that Andrew is a realtor. Andrew is he is so humble. He does not like to promote himself and talk about himself that much, but I will do it. He's a phenomenal professional in what he does. He's one of the absolute best. I work with a lot of very good real estate professionals. Andrew is definitely one of the absolute best. And the thing is Andrew is, he's locally here in Las Vegas, but he's connected with agents across the entire country. So whether you're buying here in Nevada or whether you're buying in freaking Florida, reach out to the guy. He's got the knowledge, and he's not going to BS you. Truly takes that marine mindset and applies it towards real estate, and he will take care of you and get you connected with the right people. So sorry to get on that soapbox, but when it comes to new construction, that is something that's very...
Bill, thank you for that. I'm sitting there listening, wondering, I think that I need to jump off the stream, but hey, thank you. I really do appreciate it. So that means a lot. So please go ahead, because this topic is an interesting topic.
Sorry, dude, I had to say that, man, because I've had so many people ask me, hey, do you know a good realtor? I'm like, you were watching the YouTube video, man. Yes, Andrew. So I had to mention that, because I do believe that you are one of the absolute best, and people need to understand that you are a real estate agent, not just a YouTube guy. So
yeah, and I do appreciate that, and likewise for you as a loan officer. It is important to know, and it's some of the stuff I've been learning through. Just to take a quick tangent, that I've been learning with the courses I've been taking to make better videos and stuff, is I actually do have to put myself and make it out. I'm out there, but I also have to let people know, hey, I'm actually a real estate person. But I never wanted to come across in that slimy kind of way. So I thought, well, let me just approach from passion. So back to Louisville and this question of hers, please.
So hers. Louisville Blues, great question. You want to find out what the numbers are. Again, if they're offering you a massive incentive, and either myself or another lender that you're already working with can't compete with that, then by all means, go with the builder's lender, because you're going to get a massive incentive potentially for doing so.
Yeah, and I do want to put this shout out to you now, Bill, frankly. Because there's a client that I'm getting ready to, that I'm working with, really wonderful lady that found me on YouTube, matter of fact, and reached out. And she's in contract to close on her new construction in about, 2-3 weeks from now. It's coming up pretty quick. We have her new home construction walkthrough coming up in a couple weeks, and we should be closing 3 days thereafter. And the reason I wanted to share this, Bill, is she started off with you. And we were talking about it, and then this opportunity came up because of a new home community that was in her price range, and being that she's a first-time home buyer, and the location of it, everything about the community was perfect for her. Yeah. So I told Bill, I said, hey, Bill, I'm going to be going and taking a look at new construction. He said, okay, cool. Let me know if, what she chooses to do. Well, we get there and we start talking about the rate and everything else that she would be able to get based upon her qualifications. I mean, she was already ready to go because she'd already been pre-approved with Bill, and I gave them that letter, and she had all of her docs ready to go with the other person. But come to find out, this specific builder for that specific community, which, all builders are different and all communities are different, but that specific community was going to cover like all of her buyer closing costs and kick in for all the appliances, two things that are not usual. Even the COVID-19 market, you're not seeing that a lot. So in that case, given her situation between the rate and between the appliances and between the closing costs, and she is already a little bit tighter on funds for the closing costs, as it were, that was a situation that, I said, hey, look, I know it's the weekend and everything, because she was like, hey, should I contract? Should I work on this? What should I do, Andrew? I said, you got to make a decision that's right for you. I said, and I can tell you from experience, because Bill and I have come across this. We don't come across it a lot in this kind of incentives. But when we do, Bill will sit there and tell you straight up, make the decision that's best for you. And if that's working with that builder, do it, because he can't match it. And that's what I love about working with Bill in this regard, because it's the integrity and it's the passion of helping people. Even sometimes if we don't have the opportunity to work with somebody and we would really love to, at the same time, we got to do what's right with our heart and our mind and our integrity as gentlemen and as humans. So that's one of the things of why I think Bill and I, after 6.5 years, have done so well working together. It's an integrity principle. So I do want to put that out there. When you're talking about different things, it's important to take stock of how some professionals choose to operate, and the best of the best always operate from a place of understanding what's important to a client. D Mills, thank you so much. D Mills says, hi, Andrew, you are my best realtor friend, or at least in my head. I have followed your videos my entire home buying process, and we are now closing on June 5th. So grateful for your wisdom. D Mills, so grateful for you, my friend, and thank you for the kudos. And look, it's those kind of comments that really get me going. And maybe when Bill's talking about humility and everything, to me, it is humbling. It's a blessing. It's humbling. It's exciting for me to hear that what I started 4 years ago is bearing fruit and truly impacting people and having meaningful impacts in their life the way I'd always hoped that it would. And I hope to see, where we continue to grow with our tribe. So D Mills, thank you so much. But my friend, the most exciting part in everything that you said was you're getting ready to close on your new home. So I'm super excited for you. And please let us know how that works out for you. Really, really stoked. Oh, wow. Oh, hold up. D Mills made a couple more comments. D Mills, I was able to get a 2.875% interest rate and a 3.9 APR as well. Wow.
Cool. That's awesome.
2875. Bill, can I get a 2875? Yeah,
you actually can, Andrew. Yes, you can.
Yeah. If I buy like 10 million points and pay for more than my home is worth and mortgage, right? Yeah. But that's really cool. So Louisville Blue says, as part of the same mortgage was the question. Bill already touched on that. DML says, when you want to pay more on your mortgage, do you apply it to your principal or interest? I know it's in one of your videos, I'm sure. Yes, it is. And it's principal. But Bill, go ahead.
Principal.
It's
so when you make the extra payment, depending on the lender, you want to contact them and find out how they'd like you to do that. Typically, you want to make a separate payment and pay just do a straight principal payment. Typically, what I would do in that situation, if I was doing that, is I would make my normal mortgage payment, and then maybe towards the middle of the month when I had my next payroll, maybe make another payment strictly towards principal, and do a principal reduction. Because sometimes if you pay more on your mortgage, you might be prepaying the next month. They might not actually do a principal reduction. So you want to contact your lender and make sure that you know how they like that done, so that way it's done correctly.
Right. And I know going back to Bill earlier, had shared with everybody that I did have the great pleasure and opportunity of working with him and his family personally last year to help them buy their new home. That said, Bill, obviously in 2016, when I bought the current home that I'm streaming from presently, was also my loan officer. So that said, my mortgage service provider, to Bill's earlier point in the stream, is New American Funding. They service their own home loans. So whenever I log into my account, if I want to make an additional payment onto my principal, it's very simple. I just log into my account. Since they already have my bank information, because they automatically deduct, my mortgage every single month, the smartest thing you could ever do with a mortgage, in my opinion. But with that said, is I'll be, okay, I can put $200 onto it extra this month. And that's what I do. And I put it right onto the principal, because it asks you specifically to make it really easy as a service provider to know where the money's being applied. They confirm where you want it applied. And is it one time, or is this going to be a recurring thing that you want to set up on that date? All of that stuff you can actually do inside a New American Funding service providing page for your mortgage. So whenever he's sharing with you about payment to the principal, in short, that is always what you want to do. You never want to pay the interest. The interest is calculated off the principal. So if you reduce the principal, you reduce the overall interest owed over the amortized schedule of the life of that loan. And it's a great question to emails, and I'm super happy that you brought that up. Louisville Blues gives us 2 thumbs up. So Bill, let's go 2 thumbs up. There we go. Perfect. So Louisville Blues also says, hey, one of the credit unions that I am currently working with for mortgages offering a 10-year ARM. Everybody, an ARM is an acronym for adjustable rate mortgage. 30-year mortgage. So it sounds like it's going to pivot after 10 years. For a very low interest for first-time home buyers. Are these worth it? Bill?
I don't curse.
Was there something that I said that I don't realize?
No, do not do an ARM. Why? What is the so if the current interest rates on a conventional 30-year fixed loan or FHA or whatever the situation is, if they were at 10% and you could get an ARM for 2% and it was a difference between renting and buying, and you got 10 years to figure it out and maybe refinance, hey, awesome. But why would you do an ARM right now? And like I said, I try not to curse. Man, that's really, please do not do that. That's just, again, my personal opinion, my recommendation. I weathered the storm. I was in this industry when we had to deal with all the ARMs that were done back in the day. There really is no reason to do an ARM right now. There is a lot of ARMs that I do. So, there is a reason I do them. They are in the jumbo world. They are in the high net worth borrowers to where they might have $1 million or several $1 million in the bank. And their best option is to do a 5-year or a 10-year ARM, in that situation. But for the rest of us who don't have millions and millions and millions of dollars to where if we just, felt like it one day we can go pay off our mortgage. For the rest of us, why would you do that? Unless you are that high net worth borrower that could just go pay off your mortgage if you wanted to, I would not recommend it, especially being a first-time buyer. Please give me a call. I don't know who you're talking to at a credit union. Typically credit unions are great. I love them locally for what they're good at. But when it comes to mortgages, they're guys that, God bless them, but they're hourly paid employees. They're not commission. They're going to get paid no matter what. They're going to have a constant flow of business. I only get paid commission. So I don't get paid until I close on your transaction. So I'm always going to shoot people straight because honestly, I want to take care of you. And then I want you to refer me your aunt, uncles, cousins, brothers, sisters, coworkers. But the only way it's going to happen is if I give you solid advice and take care of you. So please, if you're considering doing an ARM, take a step back, kind of like Andrew likes to talk about, JTAB, just take a breath, and don't just do it to save $100, $200 a month. It's not worth it. Please don't.
That's a good point, and thank you for that. So I have a lot of different considerations when people ask me about those type of questions too. And normally and there's 2 thoughts that come to my real estate brain, right, when that occurs. One is the jumbo world, and everybody that understand what a jumbo world is. Bill, please go ahead and get to that conforming loan.
Yeah, so the jumbo loan is when you're over the conforming loan limit of 510, 400 in a different situation. Typically, the borrowers that do the ARMs are the ones that are doing loan amounts for $1.2 to $2 million and above because they got the money in the bank to where if things go wrong, they're fine. So that's what a jumbo loan is. Sorry, thank you for clarifying that, Andrew.
It's important to understand that. So I appreciate you clarifying that. Now, the second point in my real estate brain, when sometimes it could make sense, even in today's market. I know, right? Bill's like, this is why it doesn't, but
it doesn't.
Negative. Ghostwriter, the pattern is full. Yeah. So it's a different tactic that I've taught and something that I don't encourage, but it is something that I have been approached with in real estate practice that was realistic given one specific borrower out of 175 that it actually made sense. And the reason that it made sense is a 5-year adjustable rate, and they knew they were going to be selling in 4 years. And the time of the place was real estate, Las Vegas market, 2013, which was a fast appreciating market. Now, I shared with them the trade-offs, the risks, and I prepared them, then said, hey, if this thing blows up and balloons on you, you're going to be facing the new mortgage interest rate, or you're going to be facing a pickle. And they chose to do it, and it worked out in their case. But it normally doesn't. And that's where we go into the 2008. And that's why both Bill and myself don't recommend the adjustable rate mortgage unless you're that jumbo home loan buyer and you got millions of dollars in the bank and on a whim, you could straight up pay off your mortgage. I mean, wouldn't that be nice if all of us could say,
Yeah.
I'm just going to go ahead and dabble with this loan because I want to build up my credit score, and I know home loans are good for that. But I'm tired of my mortgage now 4 years later and pay it off cash. Wouldn't that be amazing?
In today's current market, Andrew, it doesn't make sense, man. There's some guys out there that are pushing them right now.
Yeah.
Again, it makes sense if the rates, if in the next 6 months, I hope it doesn't happen, but if the rates go back up to 7, 8, 9, 10%, and an ARM is still at 4, hey man, maybe that makes sense. But if you're only going to save a quarter point, maybe a point, to me, it's not worth the risk. It's not worth your financial security. It doesn't make sense right now, anyways.
Well, it is important to note because just like, earlier on, we were being shared with one of our wonderful people in our tribe had a 2.875% rate. Well, heck, I bought my house in 2016 and my rate, I don't care, I'll tell you, it's 3.25%, right? To me, that's a smoking low rate. And I was super stoked to get it because a lot of people were getting locked in at 3.5 and 3.75 back then. So I was super happy that I had my nose clean and I was able to make that happen to get that low interest rate. But the point that I'm making is unless the rates, to Bill's point, are so high that and unadjustable, and you're financially in a position that's solvent, it's too much risk. It's just too much risk. And we don't want to see you potentially lose your home if life changes, because I think the greatest lesson of all right now, and I think there's so many to be learned from the COVID-19 world right now, I think one of the greatest lessons is just how rapidly life can change. So it's important to make a well-informed decision at the time that you're making it, and make sure that with a fixed rate mortgage on a 30-year amortized schedule, it's always going to be something that's a lot easier for you to pay off if you wanted to, and to refinance in the future if you so desired, or make those extra mortgage payments. So I just think it's important to take stock of the situation, be a little bit of a conservative thought process fiscally when it comes down to your personal finances, so that you don't lose your money in your house at the same time. So Raj, thank you for being here, Raj. And I would attempt to go your full name, my friend, but I'm afraid my country boy ways just may not get it right. So if it's okay, I'll go with Raj. Raj says, hi, Andrew and Bill. Always good to hear your helpful advice and market insight. I have a question regarding the prepayment agreement. If my loan gets sold to another company, can they change the prepayment clause if my prepayment agreement does not cost me anything to make prepayments? So it's like is there an early payoff penalization?
No. So yeah, and it happens a lot when mortgages are sold from company to company because of what they need to do to survive, to make money, whatever that case is. No, they cannot change any of the terms of the loan. If you had a 30-year fixed loan, they can't all of a sudden change it to an ARM. They can't change your rate. They can't change your prepayment penalty. So whatever your current situation is on your current loan, if that loan gets sold to a new lender, nothing can change. The big thing that you want to make sure on these, when your loan is sold, and it does happen to most of us, you want to contact the both parties on the transaction. Make sure that you're not going to have a 30-day late that hits, because I know when the cold crash happened, all that craziness is going on. I've heard of it a little bit recently, to where when a loan is sold to a new servicer, if it's sold around the time where a payment's supposed to be made, they can actually do the wrong payoff amount, and then you might potentially be hit with a 30-day late payment. So if your loan is sold, just reach out to both lenders, make sure everything is good to go, make sure the one that it was sold from, the one that sold the mortgage, got paid, the payoff for that loan was the amount that was owed, and then make sure that your new lender, make sure that the first payment date is going to be the correct one, so you're not going to have any lates, nothing like that. But no, nothing can change on the terms of the loan.
Fantastic. Thank you for those updates. And Louisville Blue did chime in about the ARM conversation a moment ago, mentioning that it had no PMI. Would that make any hill of beans difference, or is it still not something that makes a lot of sense?
I wouldn't do it.
Okay.
Because what happens, even if you flip that to an investment property and you're making good money and you're going to rent it out, and then, hey, 10 years go by, and then all of a sudden rates are back up 10, 12, 14%. And then that note becomes due. And man, hopefully you could refinance out of that or sell it. But what happens if you get caught with your pants down and you can't do anything about it? Then you're SOL. So it's not a big enough benefit to me to have that make sense. PMI is there for a reason. You can get out of it eventually if you do the proper loan. If you can qualify for a conventional loan, you can refinance out of that PMI later within a year or two, sometimes less. In FHA, you can refinance to conventional and get rid of it. So again, just my professional opinion, 15 years almost of doing this, I don't recommend ARMs in this current market that we're in right now.
And yeah, you have a tremendous amount of experience, obviously, going back to the previous collapse and 15 years. But more significant is the amount of home loans you've actually originated. It's into the thousands, thousands and thousands of families that you've helped. So when Bill shares a specific point of view, I listen carefully because he's approaching it not 15 years of experience, but actually thousands of home loans. And in real estate and mortgage, both are similar in the regard that we don't necessarily gain experience by the year in as much as by the closing. So the more experienced an agent is, the more they've seen, the more they've negotiated, the more they have better understanding and mastery of real estate, if there ever is such a thing. In my humble opinion, there is no such thing as mastering real estate because it's just too much. It takes 5,000 years to learn everything. But in mortgages, Bill is as close to, Jedi master as it gets with home loans. So I personally also would not take an ARM. I just want to. It's not something that makes me comfortable either. It makes my belly turn, just the notion of doing it. So D Mills says, thank you. Diamond Hayes says, you guys are giving amazing advice, and I appreciate this contact. Thank you so much, Diamond Hayes. Super glad that you joined in. I see that you made some other comments, and I do want to let you know. Diamond says, I hope you guys start to do this once a week. Amazing content. I appreciate you guys. Just an FYI, Diamond Hayes, I've been doing it 3 times a week until the last couple of weeks when we cut it down to twice a week for about the last 8 weeks. Bill and I do plan on being consistent with at least once a week moving forward into the future, just to do what we're doing now. So please stay tuned. And with Bill, I believe that our schedule will be fairly consistent at 9 a.m. on Mondays moving forward. So definitely, Diamond, if you're not already subscribed, please go ahead and subscribe. If you want to get notified of all the episodes, you tap that little bell icon next to the subscribe button, and you click the one that says all, and you get notified every time there's a new post or anytime there's a new live stream getting ready to drop. So thank you, Diamond. Really, really appreciate you being here and joining in. Danielle says, hey, I'm up in Reno, and I was curious if either of you had any experience with the Home at Last program through the Nevada Rural Housing Authority. Bill.
Yes. Yeah. So I've closed a few up in the Reno, Sparks, Minden area. Andrew, we closed 1 or 2, I think, last year in Pahrump. So the Nevada Home at Last program runs through the Nevada Rural Housing Authority, and there's a lot of different programs that come into play underneath that. So that would be a whole separate topic alone, a whole separate video. So Diane, if you want to chat more about that, please reach out to me. Give me a call, shoot me a text, email, whatever you got to do. And I can go over that with you and see which part of that you qualify for. I know there is typically that's going to be type of down payment assistance to where it's a forgivable second in most cases after 3 to 5 years, depending on the loan program that you choose to go with. And there is other rural programs that that work as well, depending on what you're looking to do when it comes to those areas specifically. So if you want to chat more about it, please reach out to me, give me a call, shoot me a text, email me. Whatever you got to do, and we will get back to you and see what we can do to help. But love it up in Reno. It's awesome. A little bit more, the green's a little bit closer. The mountains and all it's a little closer to you.
Good stuff, Bill. I appreciate you hitting that up. And that does bring up another question in my mind's eye. And I have to tell you off stream for privacy work purposes who this is. But one of our people that found us on YouTube a few years ago that we closed with a specific program, being the Hope Brings You Home program, not the Nevada Rural Housing Authority, obviously type situation, but very similar with down payment assistance. Was asking a question that I thought, that's interesting. Said that, I can't refinance for the first 3 years of this loan. Well, I'm getting ready to come up on my 3-year mark next month. Should I rate lock? So I want to give you that heads up. But what would you suggest if anybody else has that down payment assistance type of home loan and they couldn't refinance, they dropped the interest rate or anything until they hit that 3-year term? What would you say if it's about a month in advance of that date being reached?
So it's a two-part thing. So this program, the down payment assistance program, specifically rated to like Nevada Housing Division, Nevada Rural Housing, all that, they have not always had the 3-year wait times, 3 to 5 year wait times. They have not always had that. So first thing I would do is I would look and see when you closed. I don't know the specific date when things changed. But if you are coming up on that, if you do have one of the ones where there was a 3 or 5 year wait period, if you're about a month or 2 months out, I'd reach out to me, get an application done. Like I said, you want to get everything approved, take a look at it. If you're within 30 days, we might consider locking your loan. It might make sense to do that if the rates are where they're at right now and it makes sense to you. Because a lot of times when we did these loans, the rates were, man, right now they're phenomenal. But back when we did them a couple years ago or even a year ago, they were, low to mid fives, a couple of them in the low sixes, which is phenomenal for these individuals because they were able to use the program to get into a house. And now we're actually refinancing a lot of them out of the FHA down payment assistance that they had. Now they have some equity. So we're able to refinance them out of the FHA loan over to a conventional loan, get rid of the PMI, drop the rate in half in some cases, and help save them a couple $100 a month. So it's definitely a huge thing. Andrew, thank you for mentioning that, but that is happening a lot right now.
Fantastic. Thank you for those updates. And I'll give you the name of the information when we're off of the family that I'm referring to when we're off stream. Davina, thank you so much for joining in, Davina. Davina says, hi, Andrew and Bill. I'm in the process of buying my first home and my signing is today. Awesome. That's really exciting. Is there anything I need to know about a hybrid signing? By the way, love the content and appreciate your passion. Appreciate you joining us, Davina. Bill, thoughts about hybrid signings?
I think a hybrid signing has something to do with the whole COVID situation.
Correct.
Andrew, hybrid signing, can you clarify for me? Do you know what it is?
It depends on the vantage point that they're going to be using it from the title officer. They could actually be using like a virtual mobile notary, which is a thing now.
Gotcha.
Yeah.
Okay.
So
yeah.
Go ahead.
Sorry, Andrew. Yeah. So just like any signing, there's a couple things you want to make sure of. Mm-hmm. Your mortgage note, it's going to literally say note right across the top, NOTE. You want to make sure that interest rate is the rate that you locked in. You want to make sure that's correct, because if that's correct, that's, the rest of it should be correct. Now, the closing disclosure, which is your final closing disclosure, that's going to show all that information. It's going to show your locked interest rate. It's going to show your payment, and it's also going to show the cash to close. So as long as your not cash, it does say cash to close, but the money that you're going to wire to closing, the money that's needed from you, as long as that amount did not increase based on your previous conversations with your lender, as long as your mortgage payment is the same and your rate is locked, everything else should be good to go. I mean, that's the most important stuff to look at for sure. And then obviously your personal information, your name spelled correctly, spelling is correct, everything's right there, and then you'll be fine.
Perfect, Bill. Thank you so much for that. Greatly appreciated. So Davina, great question. Essentially, it's just another vantage point of the way of doing real estate. I'm working through some content that I did some interview with some clients about buying a house sight unseen that'll work well in a pandemic, work well in any situation, frankly. But it's a matter of your comfort level and making things happen. In the case of the COVID-19 world, a hybrid signing is just as legitimate as any others if the title company is providing it. But to Bill's point, it's really most important for you to dial in on those closing disclosures, make sure your rate's the same, make sure that everything is the same as what you and your loan officer have discussed, make sure that it's the same numbers and that everything is good to go. So if you see something or you suspect something isn't quite the same when you do your hybrid signing today, Davina, and again, congratulations, by the way, hopefully that means you're getting keys, but and call your loan officer. So if something doesn't make sense, as opposed to just signing it, call the loan officer, install, and get the question answered, because this is about you and making sure things are right. So that's my suggestion for hybrid signings. Make sure if you have a question, make a call. Diamond says, oh, I love this one, Diamond. Love it. Diamond says, hey, can you guys please tell me the truth about forbearance in your opinion and who should and shouldn't use this? I know that our wonderful loan officer last Friday, Celeste Harvey, was on, and that was the hot topic. Bill and I did it just over a month ago for the first onslaught of the forbearance, and I have a feeling we're going to be doing it a lot more in the future too. But Bill, why don't you go ahead and tackle it?
Yeah, it's pretty simple. If you need it, do it. If you can't afford to make your payment and you don't have the money in the bank, and hey, man, if you need to do it, because it's going to be a means to keep your home. It should be. Every lender is going to have their own way that they go about the repayment period of that forbearance, because it's going to be paid back in some manner that's going to have to be done. If you don't need the forbearance, please don't do it, because you're taking advantage of the situation, and there's a lot. It's not free. There's things that are going to happen. There's opportunities that you might miss. I have an individual that's a client that I had closed on two different situations. I have one individual where one of the absolute nicest guys I've ever met, one of the most genuine people I've ever talked to, phenomenal guy. He unfortunately is very affected by the current situation. COVID-19 is directly affecting his job. He may not be going back until October, November, or maybe later. He actually did contract COVID. So the guy got all of it. Great dude. Awesome guy. He has the ability to make his payment right now. He is, again, income directly cut off, has the assets in the bank to cover the mortgage payment. He's not even choosing to go into forbearance right now. He's going to see how much longer he could potentially weigh it out before he depletes all of his that he has there. He's not going to go to that point. But that is an individual that I would say he does potentially qualify for what I believe makes sense to go into a forbearance type situation, as opposed to losing his home, right? That would be something that I would recommend because he truly needs it. On the flip side of that coin, I've got someone else who reached out to me. They're making great income. They don't have a ton of debt. Their situation is pretty good. Their income dropped a little bit, but they're more than capable to continue making their mortgage payment. And when they called me about the forbearance, they didn't like my answer because I told them it didn't make sense to do that because it's not going to be free. There's going to be something that comes up. They're going into a forbearance type situation with their current loan. And what's going to happen is these interest rates are going to remain good. Their rate is not that hot throughout this next year. There potentially could be an opportunity for this individual to come back and be able to refinance, maybe even buy something different, something bigger for their growing family. And they're not going to be able to, because once you are in a forbearance on your mortgage, you are going to be, for lack of a better acronym, you're going to be SOL for at least 12 months because you're not going to be able to come back and enter into the mortgage market when you have had a forbearance on your credit for at least 12 months. So again, black and white, super simple. If you need it, do it. If you don't need it, please don't.
Great points, Diamond, and I hope, or Bill and Diamond, I hope that helps you out with that information. And again, it's stuff that as more developments unfold about forbearance, we will be talking about major developments as they occur with that. And if you want to check out last Friday's stream and hear what Celeste had to say about it as well, you'll find that it's very consistent messaging from all of us. If you can, pay it. And if you truly need it, then that's why it's there. But be aware that nothing is for free and there's going to be a piper to be paid at the end of the day. It's just a matter of how. So great point. Raj says, thanks a lot, guys. Really helpful. Thank you so much. And again, I see 2 thumbs up. So let me find my camera here. Here you go. There you go, Raj. Appreciate you. D Mill says, I did not buy my interest rate, just FYI. I have great credit, low DTI, and an absolute first-time home buyer. I'm also located in the South. Not sure if that has anything to do with anything. Hey, D-Mills, appreciate the context, my friend, and super happy that you're here. Then you timed in with, you have to be so aggressive these days buying a house. If you want to move as fast as I did, pay your own closing cost and try not to use down payment assistance. Those are both great points. And for reference, when it comes to closing costs, look, they're really cool if a seller is able to help you out with that. But here's the thing. Sellers have this thing called seller closing costs. And this is a conversation I have with every single buyer. And I've made so many videos about this topic. And the reason being is buyer closing costs are called buyer closing costs for a reason. They're the cost to originate and the cost, more importantly, to get everything set up for your new home loan. And when I got into real estate practice and I was trying to figure out buyer closing costs, and I was jotting down all these notes, and then Bill sat me down and said, hey, this is what buyer closing costs are whenever I was a newer agent, and said, this is how it works. And I said, why is it always like 3%? Why is it so high? And then Bill broke me down with, well, today we'd call it an estimated settlement statement and closing disclosure, and started going over all the fees. And then I started realizing and adding those up. And I was like, oh my God, Bill, like 2% of this 3% that you're saying is needed for buyer closing costs are actually going in the form of an impound account for a buyer's mortgage payment, for their property tax, for their homeowner's insurance. And he's like, yeah, that's correct. So it's important to realize that roughly 2 or 3% on average, if we said 3% was the average buyer closing cost, right? That roughly 2% are going right to you as a buyer. So when you ask a seller to pay your buyer closing costs, it's like, hey, Mr. and Mrs. Seller, will you go ahead and hook me up with a, go ahead and what full year of property taxes, homeowner's insurance, and make that happen. So it's important to take, it's important to put that in the context and know that. So please be mindful of that whenever you do ask that. So D Mills, if you were paying your own buyer closing costs, fantastic on you. And that's why Bill was giving you those thumbs up. And yes, you're absolutely right. Compared to a buyer that is asking for it, your offer will win every day of the week. So good stuff. Good stuff. Glad to hear it. And lastly, Louisville says, thanks again, guys. Great advice. Wishing you good luck from Minnesota. Wishing you good stuff as well, Louisville Blues. Thank you for joining in. Diamond Hayes says, thank you. And Davina says, thank you. I appreciate it. And I will be looking at those things. Fantastic. Well, everyone, thank you so much. We've been streaming for quite a while today. Moving forward into the future, we would like to probably try to keep the live streams down to about 45 minutes, if at all possible, so we can make as much impact, get as many questions answered as possible, and then get back to our GOB with helping people be able to buy and sell homes, and Bill doing his loan origination thing. But that said, hey, really appreciate everyone joining in. Bill, do you have any parting shots you'd like to share with us?
No, I really appreciate all the engagement with everybody on the live stream today, and just I think that all the questions are awesome. I love them coming in, and it's great to see people engaging in it. And just like I talked about earlier in this video, because you might have just jumped on now again, Andrew's a very humble individual. He's not ever going to sell himself. He's not ever going to come across that way. So I've got to do that for my buddy. I mean, he's truly, guys, I work with a lot of great real estate agents here in the Valley and across the country, specifically in Nevada. And Andrew is truly one of the top-notch professionals when it comes to being a real estate guy. He really, truly is. So if you've got real estate-related questions, not just questions, but if you're thinking about buying a home, doesn't matter if it's just here in Nevada, he's got contacts across the country. So please, please, please reach out to Andrew and let him kind of give you some of his advice. And if he can help out and get you guys down that right path, definitely please do.
Thank you for that, Bill. I greatly appreciate it, my friend. Yeah, it is hard for me, and maybe I'm going to have to work on it. According to the courses I take, I have to work on that. But all the same, I really do appreciate your support, my friend, on that and putting it out there.
Absolutely.
So lastly, everybody, look, we're getting ready to wind down another great stream. We'll be back live on this upcoming Friday, and there will be Celeste Harvey joining us in at 9 a.m. Pacific time. So we're looking forward to seeing you guys then. For now, thank you so much for everyone that was here. And if you're catching us after the fact, thank you. And if you haven't already done so, go ahead and subscribe to this channel and tap that bell icon to get notified of the next time that we're going live and of the next videos. And please go out there and be the reason someone smiles today. One smile at a time, we can make the world a better place. See you later.